Everyone is getting in the space pool. And this is another one of those corners. Like, okay, we've had 6 or so related space ETFs launched this year, I think. Yes, we're building the space economy, but it's all about SpaceX.
All right, joining me will be Chris Davis, Chairman and Portfolio Manager at Davis Advisors, who currently offers 4 ETFs, about $2.4 billion in assets. These are traditional, actively managed ETFs. That includes the Davis Select U.S. Equity ETF, ticker DUSA, which recently crossed over $1 billion in assets. A very nice milestone for that ETF. And I should note that Davis Advisors overall, we're talking about a $31 billion asset manager. That's across ETFs, mutual funds, SMAs, et cetera. But Chris has been in the investment management business for nearly 40 years now. I would say he's definitely a value investor at heart, certainly a high conviction value investor. You can look at DUSA. There's only 26 holdings, just to give you an idea. And so we're going to have a wide-ranging conversation around value stocks and the current market environment. We'll obviously take a look at the Davis ETF lineup. And then I also want to talk actively managed ETFs in general. This should be an excellent conversation with, again, a tremendous all-around market and investing veteran. Now, later, I'll be joined by one of my favorite ETF analysts, Todd Sohn, Chief ETF Strategist at Strategas, who's a top-ranked macro research firm that works with institutions across the globe. And Todd heads up all of the ETF research and coverage there. I'm looking forward to this because I have an assortment of random topics that we're going to bat around, including iShares and State Street filing for Nasdaq-100 ETFs, which that would finally give Invesco some competition. We're also going to discuss Morgan Stanley launching a spot Bitcoin ETF, actually the lowest cost spot Bitcoin ETF. We'll talk about ETF issuers sitting on ticker symbols, hoping for a big payday. We'll get into ETF flows, new launches. We're going to cover it all. And so Todd will join me a bit later. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in Chris Davis, who's joining me from New York. Chris, welcome back to the podcast. It's so great to see you.
Oh, thank you so much, Nate. I'm so glad to be here.
All right, so there is a lot that we're going to cover, but I thought let's start with the markets more broadly, and then we'll dive into the Davis ETFs and talk active ETFs in general. And, you know, Chris, it's been an interesting year thus far, but you look up, the S&P 500 is up 2 or 3% on the year, even though the Mag 7 is down about 2 or 3% as a group. We've obviously had a tumultuous geopolitical backdrop with the Iran conflict. There's still uncertainty over the Fed and the direction of interest rates and how they may handle inflation and a cooling labor market. And so to start, I'm just curious, what stands out to you over these first 3+ months of 2026?
Well, that there's this funny paradox that you have enormous uncertainty, right? You have, the uncertainty in terms of, interest rates and inflation. We've come out of this long era of falling inflation, falling interest rates that turned in 2022. So you have all of these deficits and printing and all of the anxiety around that. So that's a big transition, an area of uncertainty. You have geopolitical uncertainty, right? Where, the Straits of Hormuz, which have been talked about since the 70s, all of a sudden this is really happening. So you have war in Ukraine, war in the Middle East. You have the breakdown of globalization and all of the ambiguity and uncertainty around that. And then you have this radical new technology, AI, that is going to create a lot of disruption to business models, to employment data, and so on. So you have all of this churning uncertainty, which usually drives down markets. Investors hate uncertainty. And yet here we have the market not far from an all-time high at high valuations by really any standard. So you have complacency and high valuation coupled with uncertainty and ambiguity. That's an unstable system. And so I think that, it is the underlying economic fundamentals. There are things that to be are very positive about, but it has sort of amazed me how much the market shrugs off uncertainty at the moment.
Well, let's unpack a few of those points a little further. And I guess I'll come back to geopolitics and the Iran conflict. And as you know, historical data tells us that geopolitical events tend to be short-term market noise, right? These aren't typically situations that are actionable for longer-term investors. Do you see that as the case here, or might there be some more relevant impact if, say, oil prices do stay high and that creates some inflationary pressures, which that further complicates the Fed's job? Is that something you think investors should be paying attention to?
Well, I think investors are rational to always ask the question. It was Charlie Munger's, one of Charlie Munger's favorite questions, which is, what then? If people say, oh, this is going to happen, well, what then? So if you had predicted, this sort of war in Iran, and then you said, well, what then? Your history, recent history would say these things tend to be somewhat short-lived. So I think you're right. Investors would be wrong to sort of normalize that we're in the start of World War III or something like that. These tend to be, and certainly more recent times, that's been more and more pounded in versus the Vietnam example and so on. However, I just came back from visiting a bunch of energy companies, both in Texas and in Canada. And I would say that just in the same way, some of the COVID shocks reminded companies we need a lot more inventory, we need a lot more reserve, we need a lot more redundancy in supply. I think that what's happening in Iran is going to make people and countries think about that as well. So I think you could have sustained higher in spending, in infrastructure, in exploration, and that all of that could lead to higher the normalized price of oil being $5 or $10 higher than we might have thought before this happened. So I do think there'll be a long-term effect in the best case, right? The worst case is that we end up with this continued disruption. It goes on longer and longer. It has real consequences. But I think you're right. In the world of probabilities, it's probably okay to look beyond, but I wouldn't look beyond as if nothing had happened. I'd build in that change in worldview from realizing that this sort of instability can happen.
Okay, so if we set geopolitics aside, two other topics that you mentioned, AI, and then you also mentioned valuations, and I'll try to pull it together like this. Despite the recent pullback in the Mag 7 stocks, they do still represent about 33% of the S&P 500. And if you look at valuations, we're still talking about a PE of roughly 25 for that group, again, as a whole. Do you have any thoughts on the Mag 7 specifically, or even the AI trade more broadly, which obviously many of these companies are tethered to?
Yeah, I mean, I think the Mag 7 is a name that we'll look back on as another piece of convenient idiocy, right? In other words, you'll end up in a moment in investment history where media pundits lump together a group of companies, really mostly on the basis that they've all gone up, but then they try to describe them as if they're monolithic. So if you think back to the Nifty 50, right? These are just 50 companies that you had to own. 50. Well, that company included, Coca-Cola and Kodak. So companies that were wildly different in their fundamentals, in their prospects, in their futures. It included companies that were very fragile and brittle, and it also included, Philip Morris and Gillette. So, but it was just a convenient. People talked about the Nifty 50. What do you think about the Nifty 50? And I think we always say investing is the art of the specific. So then, in more recent times, we had BRIC, right? As if Brazil and Russia, India and China have anything in common. They happen to be four countries that had all been doing very well for a period of time. So people started asking, what's your BRIC strategy? But those countries are fundamentally different in almost every dynamic: culture, economy, geopolitical, economic prospects, demographics, so on. So brick was sort of stupid. And then we got FANG, right? It's all about FANG. What's your FANG and FANGMA and all of these. And so, now we have the Mag 7. But obviously, Tesla is just an incredibly different company with different prospects than Apple. Apple is wildly different than Google. These are different business models. They will perform differently in the next decade. And so they do get lumped together. We've had, less than half the weighting in the Mag 7 for this entire period. I mean, I say the last 3 or 4 or 5 years. We've managed to sort of keep up with the S&P. We've been well ahead of things like the Russell 1000 value without having that big weighting. And I think that's great, because what you touched on is that people piling into this group as if it's a group has really elevated valuations. And although they're off somewhat now, it is still a high valuation to be paying for a group of companies, all of which have futures that are difficult to predict given the changes that are coming out in technology. Is AI good for Google's search business or risky to Google's search business? These are sorts of very important fundamental questions, and you need to ask those questions when you're paying high valuations, because the higher the valuation, the smaller the margin for error if something happens that was not anticipated.
Well, and I think it's a good point just at a broader level, in the sense of a lot of investors are looking for companies that are going to be beneficiaries of the AI trade, but you also have to think about businesses that are going to be hurt by AI. It's both.
Nate, that's such an amazing point. We actually put every company we look at through a lens of how AI may impact their business. And we actually have 5 categories that we touch on. One is, who are the emerging winners? That's where all the time is spent. Oh, can I find the new hot winner? Well, look back at the internet. There were 3 surefire winners of the internet, and it was Cisco, Yahoo, and AOL, right? So it's very dangerous early in a mega trend, in a new technology, to imagine you're picking the winners. It's also dangerous to pick them at a time of maximum hype, right? Because even if you had picked Amazon in 99 or 2000, you were down 70 or 80% when people were disillusioned that the technology was taking a little bit longer to roll out than people expected. Amara's law says new technologies are overestimated in the short term and underestimated in the long term. We're in the overestimation phase. So picking the new winners, it's a dangerous game, particularly dangerous if you're investing in companies with unproven business models that need to raise a lot of capital and spend a lot of money. That's a risky place to be. So a lot of times, the next are who are the enablers of the AI technology. So think of Taiwan Semi, Samsung, Applied Materials. Think of natural gas, copper, electricity. Those are the enablers. They will make a lot of money whether or not the people spending the money on the models end up getting a good return. They're going to be the best. So they're enablers. Then they're the users. Who are the users of the technology? If it's like railroads or electricity or the printing press, the money didn't go to the inventors of the technology. It went to the users of the technology. So there's possible analogies there that the users will get more of the economic value than the builders. That certainly was the case in things like railroads and electric systems and so on. Then there's a category that I love, which we would call the protected or the insulated, right? Who are those sorts of businesses where AI is not going to change chicken production very much? So, Tyson Foods and so on. Jeff Bezos famously said, people always ask me what's going to change. They ought to ask me what's not going to change. That's a valuable question too. So there's a category there. And then the last category, Nate, is just the one you touched on, which is the Walking Dead, right? Which who are the newspapers in the early internet days? Who is Kodak in the days of digital photography? And this is something that I think will put a lot of passive investors and illiquid investors at a big disadvantage in a fast changing world, because Kodak was still in the top third of the S&P 500 after 50 million digital cameras had been sold, right? The index is very, very slow to see and respond to the future because it's passive. It sort of waits till the future unfolds. So I think a lot of passive investors are going to go down with the ship with some of these companies where active investors will be able to get out in front. And, God help the people that have taken all of this liquidity risk in private equity in a time of transition to lock up your money for 7 or 10 years on a levered basis when businesses that you're investing in could be really radically transformed by what's happening. It's a risky proposition. So that's a soliloquy. But when we think of as fundamental, long-term, research-driven value investors, looking at every company through the lens of the AI, offense and defense is absolutely critical.
All right. And I want to make sure we get into your ETFs, but you mentioned being a value investor. I mentioned that at the top, though I think I saw somewhere where you said that you're looking for growth stocks in disguise, which I like that. But if I look at value stocks in general, something like the Russell 1000 Value Index, that's up about 7% this year. Again, that's up, or compared to the S&P 500 being up 2 or 3%. Just high level, Chris, what have been some of the drivers of value so far this year?
Well, it's interesting because, I think we've outperformed the Russell 1000 value in sort of every period. I don't know about year to date, but every long, 1, 3, 5, 10, 20, so on. It's a funny distinction, value versus growth, because growth is a component of value, right? A company that grows profitably is more valuable than a company that doesn't grow. So in some ways, we say, well, we're like growth investors because we want to own what I would call quality, durable businesses. And companies that grow are more valuable than ones that don't. But we're much more like value investors in the sense that we are skeptical about how long growth rates are sustainable for, right? In other words, a lot of growth investors, you look at some of the assumptions built in to some of these tech companies, and they're assuming, 50% margins and 20% growth rates for a decade. I think fewer than 0.2% of companies in the S&P 500 have been able to maintain margins above 50% for more than 8 or 10 years. And yet people just throw these assumptions around like it's God's grant. So I think a little bit what's been favoring value in this world has simply been some of the high flyers coming down to earth. You saw it in some of the software companies that had just been absolutely on fire. So it's been a little bit a help of what they haven't owned. And then I think the recognition that, for example, with banks, that there are some sectors that are just too cheap. They're just too cheap. And they probably are beneficiaries of AI, certainly in the short and midterm. Long term, now that gets a little foggy, but we can turn to that. But I think that I think the relative outperformance of value has been driven a little bit more by the fall from grace of some hyper growth companies that were valued at crazy valuations. And that's created a little bit of a lift. And then just a swing of attention towards them. But certainly financials hasn't hurt.
Okay, so I think we've set a very nice backdrop talking markets. Let's get into your ETFs. Again, you currently offer 4 of these, led by the Davis Select U.S. Equity ETF. I mentioned at the top, recently crossed over $1 billion in assets, ticker DUSA. There's also the Davis Select Worldwide ETF, ticker DWLD, the Davis Select Financial ETF, ticker DFNL, and then the Davis Select International ETF, ticker DINT. And obviously, you're employing the same basic investment philosophy across all of these products. But let's take DUSA. Chris, do you just want to walk through the investment approach here? If somebody looks under the hood here, what are they going to find?
We've been managing DUSA. We're in our 10th year as a true, proven active manager, value manager, running a true ETF. This is our 10th year of doing it. And during that period, as I said, we've outperformed the index in, essentially all periods. And we're proud of that record. And there's so much attention on active ETFs for the first 8 years. I I think we felt, where is everybody? This is a great offering, and we think proven active management in the ETF form, and having 9 or 10 years of a record is something we're proud of. Yes, DUSA is run, but with our proven investment discipline. We've been running our flagship mutual fund with the same discipline for 55 years. We've outperformed over those long periods of time by doing that. It is a research-driven, fairly concentrated, very stock specific. We do not look like the index. I think it's one of the reasons a lot of advisors pair us with an index, because they say if we're going to have an active manager, they may as well be a real active manager. And so we don't look anything like the index. But the most compelling number I can give you, Nate, is the fact that the market is currently trading around 24, 25 times the S&P. The Russell 1000 value index is at around 20 times, 19, 20 times. Our portfolio currently trades at 14 times earnings, the companies that make up our portfolio. So that is a real value discount. And yet the companies that we own have grown faster, about 600 basis points per year, faster than the companies in the Russell 1000 value, and at about the same rate as the S&P 500, despite the fact that we have less than half the weighting in the Mag 7 and so on. So it is true active management with a true value discipline, but a focus on durability, quality of the underlying businesses. And I think that's what's really been the driver of results over all these periods for the last almost 10 years.
Chris, you've mentioned the performance of DUSA, and but before we started recording here, I did go and pull the performance. And to your point, if I look at DUSA compared to a lot of the other value-oriented index-based ETFs out there, DUSA has significantly outperformed over the trailing 1 and 3 year period. And you could probably go back further. You would know better than I. It's also interestingly beaten the S&P 500, which I think might surprise some people. But the reason I wanted to come back to performance is that one of the questions I always like to ask active managers such as yourself is around how investors and advisors should approach due diligence in the active ETF space. Because as we were talking about, again, before we started recording here, there's a lot of product on the market. And there's still a lot of product coming to market, which I think will only increase as asset managers roll out the ETF share class structure of existing mutual funds. But the point is, there are a lot of active ETFs for investors to wade through. And so what do you think are the right questions for investors to ask when looking at their options? Does it ultimately come down to performance, which we were just talking about, or how should they think about this?
Well, I mean, it's an old-fashioned word, but I think it comes down to stewardship. You're trusting your savings to a manager. And, you know, if that manager is solely focused on chasing the hot dot or selling, you know, product, it's a dangerous place to be. There's a lot of gimmicks in the ETF space. They're being created because people think they can sell them, not because they feel that they are the right way to build wealth over the long term for the people that are entrusting their savings into that fund. We are the stewards of those savings. And so what would I look for? Well, I'll tell you one thing I look for, and I look for this in every company we invest in within the funds. We look for managers that are aligned with their shareholders. So my family, my kids, my grandkids, my colleagues, our partners, you know, we're the largest investors in the funds that we manage. And that has been our promise to you for 20, 30, 40 years. So we run this like it's our own money. And I think that's important. I think the second thing to look for is not just the value proposition that somebody is offering, but sort of the credibility. Do they have a record of doing what they say they're going to do? There's a wonderful quote from Patrick Henry who said, you know, my feet are guided by the lamp of experience. I know no way to judge the future, but by also looking at the past. And so this idea of, is this credible, what these people are saying? Are they going to be here and be accountable to me and my clients a year from now, 3 years, 5 years, 10 years from now. So I think the staying power of the manager, as well as the alignment, as well as the performance, I think those are that's sort of the three legs of the stool that I would look for if I was putting my savings to a managed fund or my client savings. And I think we've come, Nate, into a good place where, we sort of say, a lot of advisors say, I've got two types of clients. I got clients that think, this is the dawn of a new era. Everything is fantastic. It's morning in America. America is great again. Go, go, go. They are the hyper bulls, and they've made a lot of money. And I think that what we offer is a good way to sort of take some of that risk off the table while still being invested, right? So we're sort of an off-ramp or an adjacency to that very bullish mindset, because in that way, we're much more conservative. But then you have another group of clients that are terrified. The world is ending. What the hell are we doing? The country's on the wrong path. Buzzards are going to carry away our children. And they're really scared. And by the way, they're not scared with no reason. There's a lot to be scared about. And they're sitting in cash, but at a time when their cash is being devalued by inflation and purchasing power erosion year after year after year. And I think we offer them a good on-ramp to sort of say, well, active value management, nimble, the ability to adapt to changing times, trusting your money, not just jumping into something that is passive and is riding the trend. I think that's sort of a good proposition. And that's the other thing that I would look for if I was looking to put money to work in this kind of environment.
Well, Chris, I think that is the perfect ending spot for our conversation. This has been greatly enjoyable. I certainly appreciate you taking the time this week. Thank you for joining me.
Oh, thank you so much, Nate, for all your research, your good questions, and all you do.
That was Chris Davis, Chairman and Portfolio Manager at Davis Advisors.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Todd Sohn, Chief ETF Strategist at Strategas, who's one of the top macro research firms out there. They have a stable of investment and market and economic analysts, to include Todd, who is obviously their resident ETF expert. And he also happens to be one of my favorite ETF analysts. Todd, it is so great having you back on the podcast.
Hey, Nate, you're a very kind introduction. I really appreciate that, and always great to join you.
And, I would say you definitely swim in the deep end of the ETF pool. I feel like there's really nowhere in the ETF space you can't or won't go. But just to give people an idea, like what does an average day or a week look like for Todd Sohn? I know you're traveling now. Explain to everybody exactly what you do.
So as you mentioned, Strategas, we have a stable of analysts here. We all cover different corners on the ETF landscape. So I do get to travel to see a lot of different clients and offer them, what they should know about the ETF industry, the growth of it, and why they need to pay attention to it, because some of them are not exactly involved in it. And then B, for our, say, more tactical type of clients, what kind of behavior are we seeing from ETFs in terms of volume? Where are flows going? What types of products are coming out, right? Because these are little interesting breadcrumbs for sentiment, but it's also, hey, you got to pay attention to a lot of stuff that's going on here, because sometimes a behavior or ignored corners can lead to pretty good opportunities.
Yeah, and I think that latter point is exactly why you do swim in the deep end of the ETF pool, because sometimes you'll go down paths or ETF areas that maybe aren't as heavily trafficked as some other spaces when you dig into those tactical insights. But look, we're going to bounce around on a number of different topics. I think I have maybe 9 or 10 different areas for us to venture into. We'll see how that goes. But to start, I'm just curious, as you look at ETFs overall in 2026, any big picture takes? I know we've had over $500 billion in inflows this year in just 3.5 months. We've had over 300 new launches. The ETF share class is now rolling out with firms like Dimensional and Thornburg. But what stands out to you so far in 2026?
The train is full steam ahead. Flows, products, all that. And what I find interesting is I am seeing, outside of some of the wackier products out there, right, leverage, etc., more and more of some of our clients who were mutual fund providers are now filing for ETFs. And either it's a conversion or it's a brand new strategy, etc. So the pool is getting more crowded in a good way. And I think it's also interesting that ETFs, especially in light of the last, say, 2 months, the usage rate of ETFs is climbing. In 2025, ETFs average about 30% of volume. In March 2026, they did about 40%. So there continued to be this great tool to, whether you're adding allocations, tweaking exposure, shorting, etc. I think the message is really out there and how great a vehicle they are to get quick exposure, especially in this kind of social media driven world out there where a tweet can change the nature of the market on a dime, and you got to get into something real fast.
Well, and to your point, you mentioned trading volume. It's just interesting because every year we wonder if ETFs are going to continue at the same growth rate that they've had in the previous year. And by most metrics, whether you're looking at flows or new launches, which I mentioned, or trading volume, which you mentioned, every year ETFs seem to outdo themselves. And it's just, I always say, we sit in the perfect spot, Todd. It's job security.
Always knock on wood, I'm thankful for the ETF industry. I'm thankful for Strategas and the folks at Manager, but there's this is a growing industry. It is the exact opposite of some other corners of the world out there. I mean, there is nonstop action going on.
All right. So I mentioned the 300 plus new launches this year. I want to ask you about a few in particular that have caught some attention recently. And this first one, which I know you've covered this space, you covered it in your research note actually today, but this first one is the Roundhill Memory ETF, ticker DRAM, DRAM, which this launched about 2 weeks ago. And I don't know if you've looked at the assets in this. It's already around $700 million in assets. So we have a surprise indie hit on our hands. Any thoughts on this ETF? Are you surprised by how quickly this has found an audience?
I am. Number one, great job by the Roundhill folks. They found a need and set it up perfectly, giving you that memory exposure, which is kind of the next leg of, I guess, the AI thing. I mean, listen, the 500, 600, 700, whatever number you just threw out there, incredible in a week. There's no doubt about that. I don't care what issue it is. What's interesting to me is, okay, you take that, seeing really big volume, and then when you look at volumes of 2x Micron, 2x SanDisk, and even overseas, 2x Hynix and Samsung, those are all going vertical too. I know there's a handful of filings out there for 2x Hynix ADRs that are going to list here. So on one hand, Roundhill's addressed the need. On the other, this is when I look into the behavior and like, okay, what's going on here? Am I being a cynic? Am I being too skeptical of like things are getting very aggressive again in certain corners? So that's curious to me. And then the end result of all this for portfolios is that semiconductors are now about 16% of the S&P 500. They did not even exist in that index in pre-2003, amazingly. And so just be aware of how much semiconductor exposure you might have in a portfolio between the S&P, the Qs, tech, etc., for whatever that's worth, if and when this story ever runs out of steam.
In terms of the Roundhill launch, I thought ETF.com, Samit Roy made a great point. Again, I don't know if you saw this, but he said that basically investors were piling into the iShares MSCI South Korea ETF, ticker EWY, which if you look, that's had about $6 billion in inflows this year. And the top two holdings in that ETF, Samsung and Hynix, about 43%. And so Samit was connecting the dots and said, this ETF had effectively become a proxy for the memory trade, obviously a bit watered down. And so this was really smart by Roundhill to come in and offer more concentrated exposure to the space. And then I believe yesterday, go ahead.
Oh, no, I was going to say, and they got smart because to get around the diversification rules, they're using swaps in there too on the Micron component of it.
No, I was going to say, and I think already we're starting to see some issuers thinking about copying this ETF. I think Tema filed for a memory ETF. So to your point, is this a marking the high point, or are we just going to have a bunch of issuers come in and we're going to see memory and this whole trade continue to grow?
Imitation is the most sincere form of flattery, which I think is what you're going to see with more memory ETFs. I mentioned semis were 16% of the S&P. The other item in this, again, being a cynic, is that if you look at it, Bloomberg has a global memory index, which is very similar to Roundhill's exposure. It's up 450 or 60% year over year. So that to me is like, are we chasing now? Are we starting to chase this product and this corner of the market? It would have been great to have it 2 years ago. Now we're getting all the launches and the activity after this massive run. So, if you're doing it, just know your limits.
All right. Another new launch that I want to ask you about, or actually it's a category of launches, space-related ETFs, which again, I know you've written about these recently as well. And once again, Roundhill, they launched a product here in March, the Roundhill Space and Technology ETF, ticker MARS. Tema, they launched one a couple of weeks ago, the Tema Space Innovators ETF, ticker NASA. Tuttle rolled out the UFO Disclosure ETF, ticker UFOD. Do you think this is just issuers pre-positioning for the SpaceX IPO, or what do you make of this? I think GlobalX is launching something here any day now as well.
Everyone is getting in the space pool. And this is another one of those corners. Like, okay, we've had 6 or so related space ETFs launched this year, I think. And okay, yeah, there's 5,000 ETFs, but it's a microcosm of what's happening. I think this all has to do with, yes, we're building the space economy, but it's all about SpaceX. And the knock-on effect of this is the exchanges and index providers changing their rules to say, hey, IPO with us and we'll let you right in. We're going to change all the old exchange rules, the listing rules in order to get those exposures. Whether that's right or not, ethical or not, that's not for me to decide. I'm sure our friend Dave Natick would have a lot to say, but I think this all has to do with the SpaceX thing. They want to get ahead of one of the largest IPOs in history and have that exposure ready.
Well, and it's good timing too, with all the attention on the recent trip to the moon with Artemis 2. That certainly doesn't hurt. Do you think there's going to be enough investor demand here? And let me frame the question, I guess, this way, Todd. If, let's say, some of the major indices do fast track SpaceX, and so investors who have broader exposure are going to have SpaceX exposure, is there still going to be enough of an audience for these thematic space plays?
I would guess 1 or 2 of them, of which I don't know, makes it out okay. Maybe not multi-billions, but I just don't see how there's room for 6 and upward funds, right? That's going to be tricky, especially for independent issuers. And all you need is one of the larger fund providers to come in and do their own space economy ETF, and that's going to be more crowding out. And at a lower fee too, right? The fees are going to matter on these things. So that's the tricky part with single theme ETFs. There's just not enough room for everybody to come into the room there. Maybe 1 or 2 of them will be all right.
Yeah, there's clearly a land grab here, or a land rush here to try to position. So I think, again, an interesting space to watch. By the way, did you see that Tuttle Capital recently changed a ticker symbol on their SPAC ETF?
Yeah.
Right. So it was for everybody listening or watching, it was SPCX. It's now SPCK. And so obviously the thought is that perhaps they sold this to Elon Musk to be used for SpaceX when that company IPOs. So do you think Tuttle hit the jackpot here?
I'm jealous. Let's just put it that way, assuming what we all think. And who has the ticker OAI? I'm assuming that's the OpenAI fund. We can all guess. I would love to know who already submitted for that and what kind of other shenanigans are going on in the ticker black market.
It is. Well, I'm sure everybody remembers Will Hershey and Roundhill again. They had the Meta ticker, and there's the belief that they sold this to Mark Zuckerberg when he changed the name of Facebook to Meta Platforms. I haven't seen any hard numbers in terms of what that transaction looked like, but the thought is that he made a pretty penny. And, you think about SpaceX, the assumption is that this is going to IPO at a valuation of over $2 trillion. And so, whatever they may have paid for this ticker symbol is obviously going to be a complete rounding error. I think Tuttle may be in a really, really good spot here. The other thing that I think is interesting about this story is that SPAC ETF, if you look, it only has like $7 million in assets. And so it would look like they just kept this thing alive to have that live ticker symbol out there so they could retain it and ultimately sell it to Elon. I mean, do you think that's what happened?
I don't see why not. I mean, and thinking about space and memory, and you saying SPACs reminds me of we had a whole bunch of SPAC ETFs. I feel like small core of those, and that didn't end up very well. But I mean, I guess so. Like, why not? If you're playing chess instead of checkers in the ETF world, and you have a ticker that might be of interest to that company, just hang on to it. I mean, good play. If I were Matt, rather than money, I would take a free ride to space. Maybe that's what I would do.
Going back to SpaceX being held in several ETFs today. So NASA's one. I know Ron B. I had Barron Capital on the podcast a few weeks ago, and we talked about that. Do you have any strong views regarding ETFs holding positions in private companies? You mentioned OpenAI. I saw ARK is adding that to several ETFs. Do you have any issues with this at all?
As long as it's done within the legal limits, it's okay. I mean, I don't have to deal with it like a market maker would, so they might have deeper thoughts. But I think the way T. Rowe, they have some Anthropic, and I want to say OpenAI in their tech ETF, and it's very microscopic. It's just enough to keep the interest going. But once you start getting 10 to that 15% limit, you got to be careful, because that's the legal limits of things. And if I'm a fund provider, I don't want to be in trouble. The other interesting corner of this, me going back to the sentiment areas, when ARK announced their OpenAI stake, I think it was the CFO of OpenAI said, we want to get this into retail hands. And that's just a comment that just kind of was a little sour to me. Like, that's this type of stuff you don't really love to read right now, putting it onto retail. I think they have the right intention, but the way it read was a little peculiar at this stage. So I think this is, the toothpaste is out of the tube. You're going to see more private equity in ETFs as long as it's done within the framework that we have. I don't see why not.
I'm sensing just a little bit of bearish or skeptical attitude from you this week between the memory trade and the space trade, OpenAI. Let me ask you this. Do you see that as an issue in the ETF space? I've talked about this topic a lot, where, and I don't fault the issuers. If they see a hot area of the market, they want to launch product into it. But from the investor standpoint, especially retail investor standpoint, it does seem like some of these launches, they look a little toppy. Is that a concern of yours?
Yeah, that's kind of what I'm getting at, where you see all these space launches, you see this OpenAI comment, this rush to get it into retail hands. It makes me a little bit more skeptical on those corners. It's still a bull market. There's no doubt about that. And as much as we've had some geopolitical volatility, S&P is still good. Global equities are still strong. But there are these corners of a little bit of frothiness, and it kind of aligns with the idea of, over the last few years, you've had rolling bear markets in different corners of the market and the economy. So whenever I just start to see the behavior like that, and then I see the levered volumes pick up and the anecdotal observations in the news, that makes me a little bit skeptical of those specific corners. I think that's probably the way to put it. But obviously, you stay invested, just adjust what your exposures are, diversify. I think diversification matters so much in the world today, when you have a lot of tech exposure, especially from the U.S.
Okay, so I'll use that to move into our next topic. If you want to diversify at least a little bit, it's still heavy tech, Nasdaq-100. And I'm sure you saw that iShares and State Street, they recently filed for Nasdaq-100 ETFs, where Invesco has basically had a monopoly on this with QQQ and then QQQM. But they're now going to get some competition from two of the three largest players in ETFs. How do you think that plays out? Is QQQ in trouble longer term?
I don't know off the top of my head what those fees are. I don't know if they announced them yet, which will be...
I don't believe they disclosed them yet.
That's going to probably be the big arbiter. Because I think Eric has talked about this with SPYM. You cut a basis point to 2 basis points, and the people will come, right? If you fee cut, they will come. So I think that'll be interesting. Of course, the Qs still have the liquidity advantage. I wonder if the appropriate analogy, to some extent, is, okay, we had EEM launch in 2003 or thereabouts, maybe a little earlier. IEMG launched later on, both from iShares, one with a much further lower fee on IMG. And if you pull up a chart of their share of trading volume, they're kind of converging, where EEM, while still the dominant liquidity vehicle, is losing share to IMG. So maybe over the next decade, those flip. That would be the risk to the Qs for me, that if there's a lower fee product, the liquidity system from State Street or iShares builds up over time and kind of erodes that share. Long ways away. And going back to what we were just talking about, I also think this has to do with OpenAI, SpaceX, Anthropic, assuming they're listing on the Nasdaq. It's also about having that exposure too.
Do you think that was the impetus for Nasdaq to ultimately license this index then to iShares and State Street? Because QQQ, that launched what, in 1999 or somewhere around there? So this has been around for a long time. And I got to imagine, I haven't looked into the full backstory around this. Invesco certainly can't be happy to have, again, two of the three largest players come in. But what do you think happened behind the scenes? Do you think Nasdaq did finally just get comfortable? And with some, to your point, with some of these companies that are going to IPO, they want this in more investors' hands?
I guess so. I mean, it's the same thing with the S&P 500, right? And even EM. There's multiple versions of these from all sorts of providers. And that's okay. I don't know if the proxy vote to change the structure from UIT to open-end had anything to do with it. Like, did that allow some legal loophole for NASDAQ to license it out further? Maybe, but that's a little bit out of my wheelhouse. It's a guess. I think NASDAQ just looked at it as, why are we not licensing out this all-time index of ours that maybe the methodology is random, but the performance has backed it up over the last 30 years or so. So I think it's a business decision is what I think NASDAQ looks at it as.
No question. And I'll just go on record now. I don't think this is anything enlightening. I absolutely think iShares and State Street are going to undercut QQQM. I really do. How substantially they undercut, we'll see. But I do think they're going to come out with lower cost products. And I think the right way to think about this longer term, which is what you were alluding to as well, is if you look at the S&P 500 ETF space and SPY and IVV and VOO and SPYM, SPY, obviously the first ETF launched ever and had this huge head start, became the largest ETF in the world. But over time, some of these other players started chipping away at it. I think that's what we'll see here. I think SPY still holds the liquidity crown, but they've obviously lost the asset crown. I think on a longer term time horizon, we'll see something similar play out here.
Totally.
Okay, so we've talked about a few new launches and these filings from iShares and State Street. Let's look at the other side of the equation, which is ETF closures. And again, I saw where you recently noted that 70% of leveraged single stock ETFs live in what you call zombie territory, which I believe you define that as less than 25 million in assets. And then I'm going to add to that, I saw a stat recently from Bloomberg where they said that the average lifespan of an ETF that liquidated in 2026 is just 1 year and 9 months. That compares with 3 years and 6 months in 2025 and 4 years and 8 months in 2024. And so the point being, there are more ETFs either living in zombie land, as you describe it, or they're just simply closing faster. My question for you, is this simply what happens when issuers are firing the spaghetti cannon at the wall? Is it that simple?
Yeah, absolutely. 5,000 products, there's only so much money to go around. And when you launch, on the levered space, right, we've started to see levered single stock closures rack up. 70% of that 300 ETF category is under 25 million, and a lot of them are in real single digits. So as much as it might be fun to do the spaghetti cannon on every stock out there that's on Reddit or Discord and picking up retail behavior, doesn't always translate into assets, and they're more lotto tickets. So I get that the big boys like 2X, NVIDIA, Tesla, Coinbase, Palantir can work, and those have worked for issuers. They can help subsidize the other launches, but putting leverage on $5 billion market cap names just doesn't work. There's a reason those stocks are $5 billion market cap. Maybe some of them will work out, but the majority of the time they spend their life as a small cap and never really see growth. So that's going to be hard for a levered product. And then the other angle of this is it's difficult for whether it was ESG or some of these single theme funds. There's just not enough room to go around in a portfolio. So I suspect you'll still see closures pile up. And issuers, like the guys at Bloomberg did, the issuers are getting, I guess, smarter and cutting bait on these dragging zombie products that are out there.
Yeah, I think it's both sides, right? In that it's much easier to bring product to market now following obviously the ETF rule back in 2019 and some of the other regulatory changes. You add to that the cost of launching an ETF has come down substantially over the past 5, 6, 7 years. And so it does make it much easier for especially some of these smaller independent shops to bring products to market that maybe they wouldn't have in the past. And I think the economics are such. I've talked a lot about this. You mentioned lottery ticket. If you launch a bunch of these, say, single stock ETFs, all it takes is one. You get one hit, and the economics are such that because these things have like a 1% expense ratio on them, you can hit a payday. The incentives are there to do this.
It's like the music industry, right? One hit wonder, and everyone remembers you forever. Whether and what you do with your money is up to you. But very similar to that, you get one song to hit. The other portion of this also is buffer ETFs are clearly big, but there's a lot of them, and not all of them are going to be able to stay afloat. There's a bunch in single digits for maybe it's the wrong month, whatever it is. I also wonder if you'll see closures there pick up too.
I think so, and that's what I was going to say. The other side of it is I do think issuers, there's not that stigma around ETF closures that maybe there was in the past, and I think they are just much more comfortable saying, hey, if we have a product that doesn't get assets into it in fairly short order, we're just going to shut the door, and we're not that worried about what the perception in the marketplace is. Now, we can debate that, but I do think that there's been enough closures out there over time that I don't think investors necessarily look at an issuer and say, oh, well, you've had a lot of closures, so I'm never going to use your products. I just don't think they're thinking like that if they're even going to the length of looking at how many closures an ETF issuer has, which are probably not.
Yeah, I was going to say, how many of us, outside of you and I and some other our peers, how many people are really looking at closures all the time? It's real down the well.
I think we're going to see, continue to see this trend. All right, continuing with my absolute hodgepodge of ETF topics here, I have to ask you about what is by far the best performing ETF in 2026, which is the Breakaway Tanker Shipping ETF, ticker BWET. This thing is up 725% as we chat here today, 725%. And of course, this tracks the cost of transporting crude oil on tankers. It holds wet freight futures contracts. But here's the interesting thing, Todd. If you look at flows, this ETF barely has any inflow, something like 2 or 3 million last I checked. And I realize some people may go, well, you're not going to chase short-term performance. It's obviously tied to the Iran conflict. And I get that. But if you look, BWET was up nearly 100% last year. So it's certainly a recent phenomenon, but it's not like this has only performed well this year. So are you surprised at all that traders or even retail investors haven't been more interested in BWET?
Yeah, I've had trouble putting my finger on this one because inevitably, whenever you get performance like that, flows tend to follow along, right? Whether it's Korea or innovation, whatever it might be. I almost wonder, is this like the limit of niche? Because it's a really, really, really specific exposure. Tanking futures. So tanker futures, I don't know. It's very strange to me that you haven't seen any flows. But this also going back to what we were talking about in the beginning is if a event happens, if there's a catalyst, there's usually an ETF that people say, oh man, I need exposure, and they rush into it. And this is the one at the moment in terms of performance. You just haven't seen it really follow along in terms of the growth of assets. But it is a great explainer for, hey, if you don't have something in your portfolio, or if you're looking for a tactical trade, the ETF industry usually provides it. You can get it on there. But yeah, I don't know in terms of the flows. And same thing for not that it's a completely different product, but the BDRY one. That's the dry bulk shipping. Similar scenario.
Yeah, I almost wonder if this went up so much so quickly that it's actually scared investors away, saying, well, if it's up 725%, it only has one way to go, and that's down. I'm not saying that that's what's going to happen, but I think
who knows?
Yeah, that might be the sentiment that it just I'm not going to jump in now, but we'll see what happens, because if this conflict in the Middle East continues and we still continue to have this back and forth with the Strait of Hormuz. This is going to continue to be in the news. So I wonder again, at some point, if investors start biting at BWET, we'll see what happens. All right. No surprise, we're running a little short on time, but I'm going to ask you about one other topic before I let you go. And this won't surprise you. I have to sneak in at least one crypto ETF question. So I'm going to go with a big story from last week, which was the launch of the Morgan Stanley Bitcoin ETF, ticker MSBT. Any thoughts on how this might fare in what is obviously a highly competitive category? This thing's coming to market over 2 years after the first spot Bitcoin ETFs launch, but you have a big name, big brand in Morgan Stanley. What do you think happens with this ETF?
I think they'll hold their own. They're a big enough company, and they're slowly growing out their whole lineup across the Morgan Stanley brand, Eaton Vance, Parametric. They have the advisor community, assuming, and I think they went low on the fee too, right? So if you cut the fee, they will come. Yeah. So give it a little time. And I think Morgan Stanley, as much as crypto performance has lagged here, I actually personally think in the near term, it's a pretty low bar to get back onto that train. You just look at the flows and the volumes have kind of dried up here, which is good for me in that perspective. But Morgan Stanley's viewing this for the long run that it's too big of an asset class to not have something available, whether you believe in it or not. Yeah, I don't love all the wackadoo products that are out there that I don't understand outside of, say, Bitcoin and Ethereum. But they're looking at it. This is an important asset class. It's a major asset class, and so you have to be involved there, which I can appreciate and agree with.
Yeah, it was interesting to me. I went to their the homepage of Morgan Stanley Investment Management the other night, and on that homepage, what are they leading with? It's crypto. And I just thought to myself, if we had gone back 5 years, and there would be this thought that Morgan Stanley is leading with crypto. I don't know that a lot of people would have believed it. How are you feeling about crypto ETFs overall? And I don't want to put words in your mouth, but I feel like you are a bit of a crypto skeptic. Maybe that's the way to frame it. Correct me if I'm wrong. But like, how does Strategas talk to clients about crypto?
So, and full disclosure, I do own a little bit of Bitcoin. I've been more skeptical on the influx of products like the 2x Doge and stuff like that. That's just getting silly, right? But I can understand if you said, "Hey, I have $100, 70 to equity, 25 to bonds, or whatever, and 5 to crypto." Like I can work with that. I think that makes sense, even if it's 3%, 1%. Strategas as crypto, we look at it as more of almost a risk and liquidity barometer, because we're not crypto pros. We don't know. We have no crypto pro at Strategas. But the assumption is if crypto is rising, the market is probably in pretty good hands, and it probably means we're flush with liquidity in that you can spread those allocations across different assets, right? You got to put money somewhere, and it'll go to crypto. So that's the interesting part of it from a kind of a market read. But I do think I think it is worth a look here in the near term because it's been pretty flushed out, and you're starting to see tech come back. And I wonder if it's a very low bar to get back into crypto. Not investment advice, but if you're looking for an entry point, it makes sense to me. I'm just mindful of I don't understand what the more esoteric exposure that's out there.
No, that's fair. I mean, there's a long tail of crypto assets. What I think is noteworthy, just from an ETF perspective, is that despite the sharp downturn we've seen from a variety of crypto assets, flows for the ETFs have actually hung in okay. There hasn't been this massive wave of outflows, and I think spot Bitcoin ETFs recently turned positive on the year, if I'm not mistaken, in terms of flows.
I think that tells you that there's people who want to allocate to it, right? It's not over exuberance in the flows, which is good, and it tells you that it's growing as a percentage of some allocations in portfolios, which is nice for the longevity of the asset.
Well, I'm going to guess Strategas does have a crypto pro at some point. We can make a side bet on that. You're going to have somebody there that covers the space. But Todd, this was a lot of fun, a nice little tour through some of the biggest ETF stories recently. So always enjoy connecting. Thank you for joining me.
Thanks, Nate. I appreciate it.
That was Todd Sohn, Chief ETF Strategist at Strategas. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by another one of my favorite ETF experts, one of the best in the business, Ben Slavin, Global Head of ETFs at BNY Mellon Asset Servicing. So we're going to talk ETF share classes, tokenization. We'll discuss where ETF issuers are innovating right now. This should be a fantastic conversation. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.